everybody. Luke Gromen, founder and president of FFTT, Forest for the Trees. Thanks for joining us on a Sunday night for our weekly Two Things That Grabbed Me Recently updates. In keeping with our quick run-through format, two things. The first off is that we have seen housing, non-defense capex, a bunch of different economic data, hard economic data, all broadly weakening, while the consensus, this is all happening at a time where consensus remains that we have 4 more hikes and a much stronger dollar still to come. Retweeted something this week noting that Jeff Gundlach, that he tweeted last night or yesterday, noting that third quarter 18 GDP was hurt by 1.8% by the U.S. trade deficit, which was the biggest such impact the trade deficit had in 33 years. And he noted that in the next 2 years, the U.S. dollar was engineered down by more than 50%. And so I think it's very interesting given what we're seeing in terms of this pronounced weakening in the U.S. economic data at a time where people still think there's 4 more rates to come. We would take the under on that. Secondly, the Dallas Fed Chair Kaplan talked last week about it's possible they will make some more technical adjustments to the interest paid on excess reserves. This to me is interesting. It's a bit of a wonky subject. The thing that grabbed me about this is the fact that the Fed is talking about this. And a reason that's important in my mind, and the reason it grabbed my attention, was that we saw last week that Zoltan Poszar, who's really the expert on some of the plumbing of the U.S. financial system, put out a report back in August noting that some of the challenges in the plumbing of the financial system around interest on excess reserves, the Fed losing control of Fed funds rate, etc., is basically U.S. government crowding out global private sector would force the end of taper as soon as the end of the year. And so to me, it's very interesting that a bit of a clue, a bit of a breadcrumb on the trail that Kaplan is talking about interest on excess reserves. So let's watch that. That could potentially be a very important data point. It would be, if the Fed tapered, I think very dollar negative, risk asset positive, emerging market positive, etc. So probably a pretty big steepening on the yield curve. So let's stop there on that. I did have a question about the Chinese-Japanese swap on currency swap in terms of what it could potentially mean for de-dollarization. Is it a big number? I don't know that it's a huge number based on the articles I've read on the subject. I do think it is just another sort of mark or signpost on the trail of where we're going with this, which is, there's a dollar shortage. The dollar shortage, one way to get around the dollar shortage is creditor nations start trading with each other, setting up, trading in their own currencies and setting up swap lines that they can use to settle any imbalances in local currency. And that appears to be what they're doing. They reopened it for the first time since 2013. And so I think it's potentially noteworthy, both as a sign of the tightness that's out there in terms of dollar liquidity, but also as sort of the workaround that's available. So before we open it up for questions, I will highlight, we've got a 2-hour webinar coming up in 2 weeks, November 13th. It's a 2-hour paid event, and you can check out all the information on our website, fft-llc.com. Really excited about it. If you enjoy these chats, I think you're really going to like this. We're going to have a full slide deck. We'll run through that slide deck, and we'll open up for interactive Q&A. Like I said, for 2 hours, limited number of seats available. So if you're interested, like I said, check out our website and sign up there, and hope to see you then. So at this point, I will open it up for questions, see if we have any questions out there. Looks like we may be having some broadcasting difficulties, and so if we'll find out here quickly if there's anything going on. Hello everybody, Luke Gromen, founder and president of FFTT here again. I think we had some technical difficulties for some reason, but opening it back up for questions in case there are some around. I'll sit tight for a moment. A lot of stuff going on this week, so I kind of figured there were some, but yeah, I had a couple of different people on the Periscope notify me there were a number of questions. So if you have questions, I apologize that you got cut off before, but please let me know what questions you may have, and we will we'll go from there. There we go. Okay, we're getting some questions now. Thoughts on yuan and the dollar? Um, Thoughts on the yuan dollar? I think are look. I think couldn't get below 7. It's interesting. You had the PBOC come in yesterday and highlight that there's going to be a fight around that they've battled with some of the speculators before, and that they're ready to do battle again. So I think it'll be interesting on that front. Look, I continue to think maybe one of the most underappreciated dynamics of what has gone on with the way China has set this up, and which we have really seen, has been the capital flight we have seen out of China has been through the gold market, right? So you saw another 92 tons of gold leave London in the September data, which is a lot. And so it has, to me, it sets up a system where you're looking at the faster yuan dollar or faster the yuan falls versus the dollar, the more gold will get imported into China. So it's gold in, capital out. But of course, the gold in vaults in the West are finite, and once it's in mainland China, by and large, it does not come back out. And it's interesting. This is not just me talking about this. This has been Goldman wrote about this over 2 years ago. A number of others have talked about it. So I think it's interesting. The bottom line is, to me, I think the governor on the whole yuan dollar is very underappreciated, and I think it's gold. And so I think ultimately, I don't know that I've answered that question very well. I apologize. I've been a bit distracted by some of the technical issues we've had here. But I ultimately, look, I think if it does go below 7, and I suppose that's possible. I don't think it's a good risk scenario for anything in the world. I think it's very good for physical gold demand. And to me, again, the governor on how far and how fast it goes, I think, has a lot to do with physical gold supplies moving from west to east. Let me see. Can I talk about tree ring regarding dollar liquidity? Hi, David. Not sure I understand your question. Can you elaborate on that? And then I'll take the next one and I'll jump back to that question. I got a question from Andrew. Thoughts of China regarding Miles Kwok and the Real Vision interview regarding that. That has been something I've thought about all weekend. I had a feeling I was going to get a question about it when we talked here tonight. I am not altogether surprised by what I heard in that interview on some level. It is a very broad topic being very narrowly approached in the context of that interview. And as such, I think it is interesting. I think it's a good one to watch. But to me, it spawns more questions than answers. And I'm not talking about just questions very specific or narrowly defined that I would ask Miles or that I would ask Kyle, but systemically a more broader and more important question. So I'm going to leave it at that on that front and see what other questions we have here. Let's see. Yeah, Andrew, there's a lot of accusations, and away from, accusations, there were some, I think some very interesting points made. To me, I think when you look at that interview, you end up with, to me, what you end up with is looking at one side of or one ledger of a balance sheet, right? So if we look at the relationship on a geopolitical basis as a balance sheet, there's assets, there's liabilities. There's only there's one aspect of one side of one ledger being looked at there, and to me, I think it's very useful to look at that, but I think you have to look at it within a context. I'll put it that way. Hi, Eric. Eric Carlos, how are you, sir? How are you? Saw you were down in the Dominican recently. Hopefully you had good weather. See, any other questions out there tonight? And I apologize if I'm a little, my normal method of doing this, I had some technical difficulties for some reason, and so it's a little different format than I'm used to, so we're adjusting on the fly. Okay. Hi, David. Latest tree ring report covered a dollar liquidity gauge. Beyond my knowledge, appreciate explanation. You bet. So David's referring to our tree rings report that we, it's a nominal fee subscription service we do every Friday, formatted in a top 10 most interesting things. If you like this format, you'd probably really get get a lot out of that report. It's interesting stories, charts, and then what grabbed me about it, a quick summary. And so to answer your question, David, so one of the things we highlighted in this week's tree rings was cross-currency basis, which is a very cross-currency basis swap is effectively the cost to hedge two different currency bonds of the same tenor. And so if you look at private sector buyers of debt, so let's say, a Japanese insurance company, German insurance company, they are going to buy, if they're going to buy a foreign currency bond, they're going to hedge out the currency risk on that. And the reason you do that is, perfect examples last year. Last year, coming into January of 17, it looked, hey, if I'm in Germany, I'm getting basically zero on debt here. I can borrow money in euro, and I can buy U.S. Treasury debt, and I can pick up a 300 basis point yield pickup. And that works great, except if the dollar falls 12% on you like it did in 2017, you don't pick up 3%, you actually lose 9%. And so when you put on these positions, you're going to hedge. And so these cross-currency basis swaps are basically the pricing of foreign buyers hedging out dollar-denominated debt. The point in it is this. Right now, based on where those swaps are trading, it is uneconomic for foreign private sector buyers to buy U.S. denominated debt. And so you hear a lot of people talking these days that, well, gosh, Euro's paying 0, Japan's paying 0, both are close to it, and the U.S. is paying 3. It's an easy yield pickup. And what they're missing, and there have been a couple Bloomberg articles highlighting this that in the last, call it month, there have been a couple Bloomberg articles noting that the FX hedged yield on treasuries is now negative. And it's a critical data point. Quite frankly, pretty much as soon as it happened, the U.S. markets went right in the tank. And it's interesting to me that more mainstream people, whether they're on CNBC or Bloomberg or on Twitter, aren't talking about it. Effectively, what it means in plain English is as soon as FX hedged treasury or yields go negative for foreign buyers, that $7 to $8 trillion, the U.S. needs to roll $7 to $8 trillion this year, U.S. government. Everyone talks about the emerging market. Emerging markets need to roll $1.7 trillion this year. It's a big number, and it is a big number. But it's a tiny number compared to what the U.S. government needs to roll, which is $7 to $8 trillion. Now, importantly, 100% of people think that $7 to $8 trillion is going to get rolled, no problem. This FX hedged yields being negative to foreign buyers all of a sudden introduces an element of risk to all of that being hedged, no questions asked. And what that means is effectively the FX swaps markets have begun sort of stepping on the U.S. government's oxygen hose. It is almost akin to, if you think about it in terms of the last crisis, in 2008, there was, hundreds of trillions of derivatives out there, and that was notional, and it didn't matter as long as everyone stayed, as long as all the parties in the collateral chain stayed solvent. And of course, as soon as Lehman went away, notional started to become net, and the system blew up. something similar is happening this time. Once FX hedged yields for foreign buyers go negative to buy treasuries, there is suddenly a decision that was never had to be made before. And I'm not saying none of them are going to roll. I'm not saying that we're going from all 7 to 8 trillion is going to get rolled to none of that 7 to 8 trillion. I'm saying for the first time in a long time, there is a decision to be made. And what this ultimately means is when you hear people say, well, the dollar's going to get a lot stronger, the dollar's not strong enough yet. The dollar's already too strong. On an FX hedged basis, the dollar is already too strong. It's choking off the U.S. government. And so, as you know, one of the smartest guys that I get the pleasure of interacting with highlight, he said there has to be alarm bells ringing in the Mariner Eccles building, which really got me interested, like I said earlier in this Periscope, about the Kaplan comments on interest on excess reserves. If that, hopefully that helps explain it. So the bottom line is that is a dollar liquidity metric. It is suggesting things are too tight now, not that they're going to eventually get too tight. And when I say they're too tight for the U.S. government. I'm not sure they care about blowing up the EMs, but they're already too tight for the U.S. government. That is going to increasingly matter. And if they stay tight, my guess is you're going to see, even in the face of weak risk assets, you're going to see sloppy auctions. You're going to see, big tails on treasury auctions. You're going to see treasury yields that either don't fall or rise or don't fall like they should and risk off. And you're starting to see some of those things. So let me see. Eric Carlos, thoughts on concessions around Iran and SWIFT? I'm trying to pay as close attention to all of this as I can. We saw last week that China had instructed its big state-owned oil companies to cut off oil purchases from Iran. We saw Iran media this week saying that they had just met with the Chinese, and the Chinese are saying that they are going to continue to developing a relationship or continue their relationship as it stands with the Iranians. I know this. If you look, the only thing right now with housing rolling over the way it is, the U.S. shale sector is being helped in some way, shape, or form by higher oil prices, and those higher oil prices are being helped by the threat of Iranian sanctions. And so, to me, one of the key factors as we look through sort of the daisy chain of events as we look out from here is if oil prices fall sharply, you can start shutting down marginal shale production relatively quickly. If that happens, your ISM indices in the United States are going to soften pretty quickly. And quite frankly, now that housing and autos are softening, oil and energy was already the biggest source of alpha, if you will, within the ISM indices, and that has likely only gotten more pronounced as housing and autos have softened. And so what all that means is if oil prices fall, you're going to see a very quick response in the ISM is my guess. And that's only going to put more pressure on the Fed, to talk about, to maybe start changing their tune. You started to see the chances of interest rate hikes of the December hike come in pretty noticeably last week. I want to say from 85% to something in the 60s. You would start to probably continue to see that. And I would think that would start to, at some point, have an impact on the dollar, but we'll see. Let's see. Historically, when FX hedge yields go negative, we've seen sudden flow changes. The last 2 times it's happened, yes. The last time they were this negative was late 2016. That was another period of time where there was a dollar shortage, very tight dollar liquidity. It was another time everyone was very bullish on the dollar. And ultimately, to me, the metric on, the bottleneck on this is the U.S. government. Like, it's all fun and games until the U.S. government starts having a little, starts being pinched. And so the Fed can tighten and squeeze the EMs, et cetera. But like I said, what this negative FX hedge yields means is that there's suddenly actually a decision to be made if you're a foreign buyer of treasuries. And last week, the U.S. offered $276 billion worth of treasuries, and with negative FX hedge yields, risk markets didn't take that so well. We only have another $7.75 trillion to go in terms of a roll over the next 12 months. Again, the big read to me is that the dollar's already too strong on an FX hedged basis. Let's see, what other questions? I'm going to try to see if I can see how else these questions roll in here. It looks like that might be about it. Let me. Are we better off in a unilateral system around the world? I think it depends on what seat you're sitting in. I don't know, better, worse. I think it depends on what part of the cycle you were in. I think it depends on who the unilateral power is. I think, I think ultimately there's a number of different puts and takes to that kind of a question. I do think we are moving from a unilateral system to a more multilateral system. I think it also I also think that most of the authorities, leadership position, most people in leadership positions in the United States, in particular, have never experienced anything but a unilateral system, and so. I'm not sure a lot of people in seats of power or important seats have a lot of experience in dealing with a multilateral system like some of the more real elder states people, whether you talk about a Kissinger or some of those types of folks, Harold Malmgren, who's, worked for a number of different administrations back in the 60s and 70s. These guys are elder senior statesmen, people that came up at a time when there was a balance of power between the U.S. and Soviet Union, those blocs, and the way you went about your business was very different than the sets of leaders we have in Washington today and around the world, I guess, to a certain extent, where it's been the U.S.'s way or the highway, and that seems to be changing. And so I think we're going through some bumps and turbulence as we go through that, and hopefully, that turbulence won't get too great. So, all right, looks like that's probably about it on questions. I am going to get jumping from here. So, thank you guys for being patient with some of our technical issues today. Again, if you're interested in doing or in participating in that the 2-hour paid event that we're going to do on the 23rd, on the 13th of November, take a look at our website, FFTT-LLC. And like I said, we'll have a slide deck for that. We'll go through the slide deck, and you can find out information over in the questions section that just popped up now. Otherwise, thanks for signing on, and we'll talk to you guys soon.